Hello everybody and welcome back. Today we have, of course, the UK meddling in crypto again. We have the UK is implementing a new requirement for crypto firms to report every single customer transactions starting January 1st, 2026. As what they call it, part of a broader initiative to strengthen crypto tax reporting practices. This move is driven by several key objectives. We'll get into in a minute, but we have tax compliance, regulatory clarity, and global alignment. You've heard these through the last couple of videos. They keep banging on about these. Ultimately, they just want your more hard-earned money. You take the risk, they get the tax. So we have here. The initiative reflects the UK's government broader goal of balancing industry growth with consumer protection, of course they're helping us, and financial stability. By integrating these rules into the existing financial framework, the UK aims to create a robust system that supports the crypto sector while addressing potential risks like fraud and tax avoidance. Of course, they're helping us with fraud. What I'm going to try and do here is try and give you some pros, best I can, and some cons, of course. So, for the pros, we have, again, increased legitimacy. Strict regulations can enhance the credibility of cryptocurrencies in the eyes of traditional finance institutions, governments, and the public. This could lead to greater mainstream adoption and integration into the financial systems. Then we have consumer protection. Detailed transaction reporting makes it easier to track and investigate suspicious activities, reducing the risk of fraud, scams, and illicit use of crypto. This could improve trust amongst users and regulators. Then we have regulatory clarity. A well-defined framework provides crypto firms with certainty about their obligations, potentially attracting more businesses to operate in the UK. This clarity could make the UK a competitive destination compared to regions with less defined rules. We have tax revenue. Improved tracking of crypto transactions enables the government to collect taxes more effectively, generating revenue that could support public services or further regulatory development. So that's the pros. Now we have the cons. We have privacy concerns. Requiring personal data for every transaction undermines the anonymity that many crypto users value. This could alienate privacy-focused individuals and push them towards unregulated or decentralized platforms, DeFi, and privacy coins, which governments are trying to get rid of. Compliance costs. Crypto firms, particularly smaller ones, will need to invest in systems and processes to collect, store, and report the required data. These costs could strain resources, potentially driving smaller players out of the market or discouraging new entrants, but also we have a GDPR, so that is a whole another ball game there, and a whole lot more cost to that as well. We have potential overreach. Penalties for non-compliant or inaccurate reporting up to £300, it's nearly $400 per users, are significant. There's a risk that enforcement could be overly punitive or disproportionately target certain firms or, of course, individuals. Impact on innovation. The added compliance burden might deter firms from experimenting with new products or services, potentially stifling innovations in the UK's crypto sector. And, of course, you take the risk, we take the tax. Thank you very much. It's not that good at all. So, in summary, the broader implications for crypto is the UK's approach could set precedent for other countries adopting similar tax reporting frameworks. Remember, we'll go on about MiCA, which is Markets in Crypto Assets regulations in Europe. And of course, you have over in America as well. The UK offers a more flexible stance, allowing foreign stablecoin issuers to operate without registration and imposing no caps on stablecoin volumes. This could make the UK an attractive destination for crypto firms, potentially boosting its position in the global market. However, the long-term effect depends on implementation and the industry response. While increased transparency and legitimacy may drive adoption, privacy concerns and costs could fragment the ecosystem, with some users and firms opting for less regulated alternatives. Ultimately, this move reflects a trade-off between fostering a regulated, trustworthy crypto environment and preserving the decentralized, privacy-centric ethos that originally defined the industry. Thank you so much for watching. Please do subscribe and comment down below. See you in the next video. Bye.